Let's step back in time. The year is 1979. The economy is a mess. Inflation is in the double digits, and there's a deep sense of uncertainty in the air. It's against this backdrop that Warren Buffett sits down to write his annual letter to Berkshire Hathaway shareholders. And what he produced? Well, it wasn't just a report. It turned out to be a timeless masterclass in how to think about investing. And believe me, its lessons are just as critical today as they were back then. Right out of the gate, Buffett hits you with this piece of hard-won wisdom. No fluff. This one sentence just cuts through all the hope and hype that surrounds a turnaround story. You know the kind. It's a powerful warning against falling for the allure of fixing a broken business, and it's the perfect way to kick off the core principles he laid out in this amazing letter. So what's the first big idea? Well, Buffett argued that in an inflationary world, basically all of Wall Street was obsessed with the wrong numbers. They were trying to measure success, but their yardstick was completely broken. Now, the big illusion everyone was chasing was earnings per share, or EPS. But Buffett saw a massive flaw. He famously said that even a stopped clock could look like a growth stock. How? Well, think about it. If a company just holds on to its earnings, even if they're just sitting in a savings account, its capital base gets bigger, which means its EPS will automatically go up. The reality, he said, the number that really matters is return on equity. The key question isn't did earnings grow? It's how well did management use the capital it had to generate those earnings? That's the real test. And here it is, in his own words. But you gotta pay attention to the fine print he adds right after, without undue leverage, accounting gimmickry, etc. See, it's not just about hitting a high number, it's about the quality and the sustainability of that return. It's a measure of true economic performance, not just clever financial engineering. Okay, so let's say you find a business with a great ROE. You're all set, right? Well, not so fast. What happens when the outside world, when the economy itself, starts to eat away at your returns? This is where Buffett gets brutally honest about the 1970s, and he introduces his next critical framework, the mirage of high returns during inflation. Buffett basically asks this exact question, and it's a real mind-bender. I mean, imagine seeing a 20% gain in your portfolio. You'd be thrilled. But in 1979, feeling good and actually getting richer were two totally different things. Let's walk through the math he laid out. So we start here, a 20% gain. On paper, this looks fantastic. You've grown your capital by a fifth in 1 year, a huge success. But then reality bites. In his example, Buffett uses a 14% inflation rate. Ouch. All of a sudden, that incredible 20% gain gets slashed. Your actual purchasing power, what you can do with that money, has only gone up by 6%. But wait, it gets worse. And here is the final brutal cut. The government taxes you on the nominal 20% gain, the number on the paper, not your real 6% gain. Buffett figures that tax would chew up the entire remaining 6%. So what's the end result? Your 20% home run has left you with a grand total of 0 gain in purchasing power. You ran in place, or maybe even went backwards. And this leads him to coin this devastatingly effective term, the investor's misery index. It's a simple formula, inflation plus the tax rate. If that number is higher than your investment return, you are losing ground. Your real capital is actually shrinking, even if your account statement is showing a positive number. You know, one of the best things about Buffett is that he doesn't just preach from on high. He shares his scars. He illustrates his next huge lesson with a painful mistake he made himself, the purchase of a New England textile business called Wambeck Mills. I mean, look at this. You can see what trapped him. On paper, it was an incredible deal. A classic cigar butt investment. You know, one last free puff of value. He bought the assets for so cheap, it looked like there was no way he could lose money. But the reality of owning the business was a total nightmare. And this just perfectly illustrates the problem with bad businesses. They're a black hole for energy, for time, for capital. For every single problem they fixed, a new one would pop up. It was a money pit that ate up management's most precious resource, their focus. And this was the lesson that came out of all that pain. It's now one of the most famous lines in all of investing. The Wambeck disaster taught him that the purchase price is just one part of the story. The quality of the business you're buying is what really, truly drives value over the long haul. Now, Buffett's razor-sharp analysis wasn't just for stocks. In that high inflation era, he saw a huge, unrecognized risk sitting right in the middle of almost every institutional portfolio, long-term bonds. He pointed out this absolutely staggering hypocrisy happening in his own industry. You had insurance managers saying, oh, we can't possibly predict costs 12 months from now to price an auto policy. Inflation is too unpredictable. And then they'd take the cash from selling that policy and immediately lend it out at a fixed rate for 30 or 40 years. It was insane. They were acknowledging the risk of inflation with one hand while completely ignoring it with the other. So he sums up his view with this clever twist on that famous line from Hamlet. In a world with high inflation, locking in a fixed return for decades is just a guaranteed way to lose. You are ensuring that your future purchasing power is going to get destroyed. All right, this brings us to the final big theme of the letter. And it's less about a specific asset class and more about a mindset. Buffett explains his whole philosophy on how he communicates and, most importantly, what kind of shareholders he actually wants for Berkshire Hathaway.
He uses this absolutely brilliant analogy from another legendary investor, Phil Fisher. Think of a company like a restaurant. You have to decide on your clientele. Are you serving fast food to people who are just in and out, your short-term traders? Or are you an elegant dining establishment for long-term owners? The key is you can't keep changing the menu and expect to have a happy, stable group of customers. Berkshire's menu is crystal clear. Long-term compounding. They want owners, not renters.
And this is exactly how you cultivate that kind of clientele. You treat them like partners. Buffett was adamant that the annual report should be a straight-up, candid conversation from the CEO directly to the owners. You talk about the wins, but just as important, you talk about the mistakes. It's all about building trust for the long, long haul. So as we wrap this up and look back at these powerful ideas from more than 40 years ago, focusing on ROE, calculating real returns with the misery index, putting business quality first, and thinking like an owner, it really begs the question. In today's market, which is so often driven by headlines and short-term noise, which one of these timeless lessons do you think is the most dangerously ignored?